Hello there, this is James and you're watching Tixee Live. And a very good morning and very good afternoon to all of you, and all of you a very happy Thursday. In today's program, I want to discuss another central bank, another 75 basic point rate hike, but a very different message and the impact that can have on the sterling. But before I get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So, we all know what happened last night with the Fed. They raised interest rates at 75 basic points, which everybody was anticipating. And more importantly, the press conference was extremely hawkish. Well, we had another central bank today, which I mentioned this morning, raise interest rates. And they did indeed raise interest rates by 75 basic points. So the same rate hike, and pretty much how the market expected. And this rate hike, actually, or the size of it, is actually the biggest increase in 33 years. Now, 7 of the MPC members, these are people who vote on the Monetary Policy Committee, who vote for the rate hike. 7 members, there's 9 members in total. 7 members voted for 75. 1 member voted for 50, and 1 member, very dovish, voted for 25. Now, here's the thing. This is the point I wanted to have a little chat to you about, and where I see the current situation. Now, both the banks, both the Fed and the Bank of England, raised interest rates by 75 basic points, the same rate hike. Okay, the Fed is around 4%, and the UK is now around 3% interest rates. Okay, but the press conferences could not be more different. Don't forget, the Fed, Powell was, again, determined to say, we might slow down the size of the hikes, but we're not stopping. We're not going to pause. We don't even know how high we're going to go now, because we are absolutely committed to get inflation down. The Bank of England was very different. First of all, it sees the UK falling into recession. They've already said this, but they see 2 full years of recession for the UK. That is actually, if that's the case, that's the longest recession since records began in 1920. Longest recession UK has ever experienced since records began in 1920. As well as that, he went on to say, we have a very challenging 2 years and a tough road ahead for UK households. The shock to the economy from the Ukraine war is greater than in the 1970s. They also went on to say they expect unemployment to double to 6.5% within those 2 years. But here's the major difference, a very, very gloomy picture to paint for the UK indeed. But the main big difference from the Fed and the Bank of England is because the Bank of England said peak interest rate will be lower. So what the market is pricing in for interest rates for the UK to go is going to be lower than anticipated, meaning they can only go so high, or else they're in trouble. Whereas the Fed last night said, we don't know how high we're going to go. We're going to go as high as possible. So that's the problem. Now, that's a huge problem, because the Fed can do so much more than the Bank of England can. Now, yes, indeed, the last month or so has been incredibly traumatic for the UK, And though it looks like for the time being, the political crisis is over, the economic one has just begun. And the way, how you look at it, the sterling is still overall down more than, close to 15% year to date against the US dollar. And we'll have a look at the market in the moment, where the sterling is, because it's not had a great day. It's found a bit of recovery, and we'll talk about those levels in a moment. But the other point I wanted to make, and again, I've said this point before, is that the ECB and the Bank of England Bank of Japan are in very much different situations than the Federal Reserve is. Very different. Okay, because the Federal Reserve can pretty much, they've got a strong, reasonably strong, actually very robust labor market, which we talk more about tomorrow, which I think is going to be key. And they can be more aggressive with interest rates. And it's the fact of the matter is, the stronger dollar, which is being surged, or dollar strength has been surged by the actions of the Fed, is hurting all the other countries' economies. As Christine Lagarde said the other day, well, actually a couple of weeks ago in the Bankers Summit in New York, she said, our central banks, we do work together, but we do need to, understand the spillover of our actions. And like I said a couple of weeks ago in another video, back in the 1980s, when we had a strong dollar, they got together to weaken the dollar to help each other out. But there is no signs of the Fed doing it. In simple words, it's our central bank. It's your problem if you can't handle what they do. Because what the Fed is doing, okay, is weakening the economies of so many other nations. Obviously, the UK has its own problems. You've got economic slowdown. The Brexit situation has not helped that. Okay, so we've got economic slowdown, but it also has the energy crisis like the EU has. So that is the other thing as well. So anyway, we've got a strong dollar again. And like I said, the sterling has had a bad day of it. Let's have a quick look at it, where we are with the sterling at the moment. Okay, as you can see, obviously this was driven on by the Fed's press conference yesterday. Before the conference, like I mentioned this morning, it was trading around the 115.57 handle. It's now at the 112.16 handle, obviously not helped by the Bank of England press conference. And though a fairly bullish interest rate hike of 75, could have done, they've done 100, possibly. That would have been, a pretty strong move by the BOE, but they didn't. But it's the press conference which is hurting them the most. Anyway, for now, if we look at the daily, because I like to look at levels on longer term, as I mentioned this morning, it has found a potential support around the Fibonacci level, potential area of interest 1.1175. It touched that, and it has since bounced back above that. So that is holding for the time being. But like I say, as this more develops, as we see, looking at the short rate, it has bounced, but overall, it's not had a good day yet. So 1.111. So 111.75 is a potential area of interest. Euro, okay, it's also had a bad day, but this is not because of any action by the ECB or central bank. This is down to the fact of obviously strong dollar. Currently trading at 0.9774. Again, since the US session started, it's managed to find a little bit of a boost back. Dollar yen, again, here you go. We had dollar strength, but again, we had a little bit of yen striking back, currently trading at 147.86. S&P 500, again, has been under a lot of pressure, especially after the Fed last night. It's had a little bit of recovery, but still slightly under pressure, 3,730 points. So, yeah, really needs to get, again, strongly above that potential area of interest of 3,796 points to try and gain some momentum upwards. So that's where the potential cap is. Gold, again, still tested that key level of $1,615.69. Currently trading, above it slightly by $10 or so. Currently trading $1,629, but still pretty much in that tight range. This is more being punished by the bond yields as well, which are rising again in the US. So yeah, there we have it. Market slightly down, slight bounce, but still pretty much pressured by the Fed and the strong greenback. Coming up, what else? Oh, yes, we have had some data out as well. And this brings me up to what I think I want to talk about tomorrow. We had obviously US initial claims, and this is what I said earlier on. This is the thing. The Fed has a really strong, robust labor market. US initial claims came in announced at 217,000 versus 220,000 expected. Again, better. That means less people are signing on for unemployment benefit for the first time. So again, it's shown the labor market is very strong. Continuous jobless claims was also slightly higher, but it's not growing very dramatically, meaning people who are unemployed are able to find jobs quite quickly. So a very strong, very, very, very strong labor market. The one thing, hey to you too. Hope you're good. The other bit of data came in, which was a little bit less than anticipated. Might explain a little bit of the bounce, but not massively. US ISM Services PMI announced at 54.4 versus 55.5 expected, so lower than expected. However, don't forget, it's still north of 50. Like I say, anything above 50 is still reasonably positive. So though it's lower than anticipated, it's still pretty good. It's still above 50, unlike so many other PMIs from other nations. But anyway, this is all leading up to one really big thing, which is happening tomorrow. And this really goes on to what I was saying about the labor market. This is a cruncher. And this is, of course, the US non-farm payroll at 12:20 p.m. UTC. I will be doing a watch along at this time. The announcement comes out at 12:30 p.m. UTC. I'll be going on air 10 minutes beforehand so we can have a little chat about it, the scenarios about this as well, look at the potential scenarios and what could potentially happen. Expectation is for it to come in at 200,000. Previous number was 263. Will this show us at last the labor market's beginning to cool down? Don't forget, the ADP employment change came in better than anticipated. It came in at 100. It was expected 198,000. Came in above 200,000. Now, I'm not one of those traders who believe that those two are correlated in any way. Oh yeah, you love your watch. I love the watch alongs. Oh, good. I'm glad you like them. They can be, as long as the data is exciting, the market moves, then they'll be good. If it's a flop and the market doesn't do anything, then they're not so much fun. Not like I say, I'm saying that I'm one of the traders who think the ADP number will reflect what the NFP number is. I don't always see the connection between the two. But like I say, this potentially could be huge. Because it's all about this number at the moment. Next week will be about the US CPI, because if we do get a better than expected reading, the market could then go, right, the Fed said they're not going to stop, and this is giving them more fuel to carry on being aggressive. If it comes in weaker or lower than anticipated, long last, we can start seeing the labor market start to cool down, and then potentially the market will start going, okay, all right, they're going to give us small rate hikes, and we can handle that. So anyway, it's going to be a really, really big day. So please come and join me for that. Remember, 12:20 p.m. UTC for the watch along. The market, as it currently stands, S&P 500 in the red, slightly negative 0.76% for the day. Nasdaq currently trading negative 1.24% in the red, and the Dow 30 negative 0.43%. Don't forget, you can ask me questions anytime you wish, or simply share your opinion. Let me know what you think. Well, tell me how your day's going. Are you having a good day? Are you going to join me for the NFP tomorrow? Were you able to join me for my episode of Trading School last night? And if so, did you enjoy it? Like I said, that was the second episode we did. We're doing another episode next week. I will obviously be sharing the link with that next week with you, so do come along for that. It's a really good episode last night, really popular. I had a lot of questions, which is excellent, because I love questions, especially when we're talking about education. Can I ask, you always keep an eye on the housing market and unemployment. Has there been any improvement in the US? Housing market, no, not the housing market, not at the moment. Interest rates have dropped a little bit down below 7% today, but they are expected to continue to rise. But again, like I say, I'm always keeping an eye on the housing market. It's a story which is not talked about a lot, but I do think it's going to be a big story, especially for Canada, the UK, and for the US in particular, as they continue to raise interest rates. So I'll be keeping a close eye on that. Unemployment for the US, 3.6 is the expectation tomorrow. Still record lows. Still very, very, very good unemployment. So I think it was 3.5. I think the expectations to increase slightly to 3.6 tomorrow. So that's the anticipation of that. But good question. Like I say, look out for the next episode of Trading School, which I will be sharing the link next week. Yesterday's topic was understanding support and resistance. I did it with my colleague, another fellow market analyst. It's a good episode. We had some good interactions, so keep an eye out for that. Don't forget, if you think of a question later, you can put it in the comment section, either on Facebook or YouTube. I will see them, and I will reply to them next time I go live on air, which, of course, is tomorrow at around about 9:30 a.m. UTC. So please come and join me for that. And again, obviously tomorrow, the watch along, like I've already said, at 12:20 p.m. UTC. And for the US session, again, at, it would be what, 3 p.m. UTC, or around 3 p.m. UTC. So please come and join me for that as well. So remember that. And we should be an interesting day tomorrow. The NFP in particular, I'm looking forward to. NFP tomorrow, US CPI, two big events coming up, which really can spook the market even more. Okay, if there is no questions, like I always say, if you're watching me on Facebook and you enjoyed this little video, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little video, subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video, find it interesting, insightful, and you've put up with me, my over-the-top enthusiasm for the markets, I simply cannot help, then give me one of those. It's nice to know that you like what I do. Anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, every single one of you, trade safe.